Hi, I am Madan, Fund Manager Sundaram Alternates. I am here to discuss with you about the market outlook post coronavirus as well as our key portfolios CSOP and SELF. First on the market outlook, markets have made a good decent bounce from the lower levels and there are various reasons for it, and some of the reasons that being discussed are: one is the huge US government stimulus package which addresses the concerns in the MSME and trading sectors where there is due to lockdowns literally no business. So the US government has literally opened its balance sheet to buy out any weak loan books from the financials, and this seems to have addressed the concern of the market in the short term. So we feel from a large financial institution blowout sort of a scenario, it's slightly behind us. So we feel that is allayed concern of the market, and we have seen a good degree of bounce back. Also, there is talk about infection numbers coming down or plateauing in developed markets. In South Korea and China, they have kept it at the tight lower levels for a very long period. So market is getting positive on these factors, and there is a bounce now. So where we go from here, I think the key data to watch from here on is we should expect at least the second wave of infection doesn't start. US and other European countries infection numbers should start coming down. These are the key data to be watched out from the coronavirus point of view. Also, how the economic impact would be because of the coronavirus lockdown that we have seen. So the key risk that we feel for the market from here on is, first is the economic slowdown because of the coronavirus lockdown that is happening not just globally, also in India. I think it could be slightly more than what the current market situation is factoring in. So during the next 2 months, as the earnings season starts, we think there will be a lot more volatility in the market, and therefore we expect some correction also possible, because in our expectation the economic impact of the lockdown is much more severe, and even a growth number of 2 to 3% that various economists have put forward for India might look very difficult unless the government comes out with a massive stimulus package. So I think that is getting underappreciated by the market. We need to be very careful on that front. So during the earnings season, we might get some bit of a volatility back into the market. Second, how much India can support. US has made a huge stimulus package and they have addressed the concern straight away, and a lot of businesses there are borrowing, smaller businesses are borrowing at lower interest rates and by paying the salaries for the employees, and thereby at least continuing with the business momentum. And whenever they open, they can come back. And in India, if you see whether we can give such huge stimulus package of addressing the entire MSME sector concern because of the lockdown, we have to wait and see, because our balance sheet is much more lesser, and there is already a fiscal slippage, and how much more the government is ready to go on this front is something we have to watch out for. So our expectation is doing something similar to US will be difficult for India, but if the government can be innovative here, I think government can address some of the issues here. But we have to wait and see, because given the constraints, how much government can address these issues is something which we have to see. From a regulatory point of view, RBI can relax certain norms which can avoid too much stress in the financial space. So these are something which you have to wait and see for. And even from an infection point of view, since we are doing around 20,000 tests right now in India, we have to wait for the test numbers to go to lakh and then see that the infection rate doesn't spike. So that is again a risk from an Indian market perspective. So if you are talking purely from India point of view, I think India's ability to give a stimulus package and India's infection curve and then the earnings season, all these three are key, and any positive news here will take the market up from here, and it might be mostly aligning with the global market, and any negative from here we might be diverging from the global markets. This is our view on the market. So we have talked about the market outlook right now, which can be volatile in the short term. But if you look at from a 2-year perspective, I think market is giving a great opportunity for investors to come in. and how sectorally they have to choose. I will discuss about it, and then I will cover our strategies, ESOP and self. If you look at, there is this general opinion that we have to move sectorally defensive. That might help you in the short term, but mind you, there is no upgrade happening in any of this defensive sector like FMCG, pharma or utility. In my opinion, people trying to hide there into defensive at the short term might benefit in the short term because they don't fall like the way financials or a consumer discretionary will fall, but in the longer term, allocation there may not yield you much return because we are not seeing any upgrades happening in these sectors and the valuations are already high back to the peak. But if you look at the small ticket consumer discretionary names, here the spending has come down, but it has come down forcefully because of the lockdown. But once the lockdown period is over, I don't think people will cut down massively in their ability to spend for branded apparels, entertainment, QSRs, dining, all these areas. Travel they might avoid because of the social distancing issue that is required, but that will be little far also. But I think once we are fairly comfortable with the new infection case, and we are seeing that happening in China and South Korea, that people have started coming back and started going back to malls and all. The footfalls are still low, but the recovery has started already happening. So therefore, in my opinion, any investor who looks at from a 2-year perspective should start accumulating stocks in the consumer discretionary names, particularly the small ticket consumer discretionary names. And there are quite a good number of companies there with good balance sheet, good management, long-term approach towards to the business. These are scalable businesses because the wallet share of an average Indian will be more towards consumer discretionary than FMCG. FMCG has been struggling for growth, and they've been growing in single digit, but some of these consumer discretionary names have been growing before the coronavirus impact at even 10% volume and 15% revenue growth. You have seen that happening with Trent, you have seen that happening with Titan, QSRs like Jubilant Food and all this. We will come back to it. If not in FY21, FY22 can be a year of complete recovery, and these stocks are available at a cheap price right now. So rather than moving defensive in consumption, I think a phased investment in consumer discretionary would be a better option. Second, on financials. Yes, financials will go through a tough phase. Next 1 quarter to 2 quarter can be really tough for financials. We have seen that from some of the global financials results in last 2 days. But look at this way. Private banks have been continuously gaining market share from PSU banks. And that won't change much. In my opinion, PSU banks will face further problem in capital because of AT1 bonds issue, as well as NBFCs, MFIs going through tough period will hurt PSU banks further because they have a large exposure there. While private banks who have a good liability side will be able to come out of it much quicker. For example, the ROIs of some of the private banks like HDFC Bank, Kotak Bank are as high as 2% plus. There will be an increase in credit cost that will impact the short-term revenues, but in the longer term, you will see these companies coming back to normalcy in FY22 and valuations moving up stronger. So in our opinion, investors will do well by taking a 2-year view and accordingly align the portfolio right now rather than trying to be defensive, because I think the recovery can be much stronger once a drug is in place or the infections come down much lower than what we expected. Two portfolios, the ESOP and self portfolio, both of them have a very high exposure. They had a very high exposure towards financials and consumer discretionary. We have reduced our weight. We are in cash right now, but we will invest back into these names at the appropriate time as we get more conviction on the short-term, the medium-term outlook, short and medium-term outlook on these fronts. From a portfolio point of view, we have made some changes to the portfolio. We have made it more diversified because we got some companies in the material space like Sri Cement, Astral Poly, which are long-term compounders but were valued at a very high valuation. Because of this correction, we could get them at a real good value bargain, and we have invested into it. We have also invested into a healthcare company, Metropolis, which we got at a real good valuation. And healthcare should be the first ones to recover in India. So we have those kind of changes we have made. Portfolio is now well diversified. The weights on the financials, weights on consumer discretionary is low. We have cash also in the portfolios, which will invest back. I have to highlight something here. 2 months back, we had started getting worried about the valuations in some of the portfolios, and we started becoming slow, investing slow for some of the investors who came in the second half of Jan and in the February month. Some of these investors are sitting with pretty good alpha right now, primarily because the investments were made very gradual for them. And I think from here also we will invest gradually in our portfolios. From a 1 year perspective, we have fallen in line with the market in the last 1 month, but despite that, from a 1 year perspective, in our CSOP portfolio, we have almost 14% sort of alpha. And this alpha was possible because of our disciplined approach towards concentrated investment in portfolios, companies with good balance sheet, good earnings growth, and good management. And therefore, I think if you are disciplined and run a concentrated portfolio, because a very diversified portfolio in these kind of markets might not be yielding a good result because economy itself is in a slowdown situation. There will be not many fast growing sectors, and therefore a disciplined approach towards investment over the next 2 years in a concentrated way will be helpful. And that's what our mantra has been in the CSOP, and that's what has helped us to create this huge alpha over the last 2 to 3 years time period. When it comes to Sundaram Emerging Leaders Fund, which is a mid and small cap fund, first issue, whether mid and small caps make sense at this point. The fall has been similar, almost similar. There could be slightly higher in mid and small cap, but it has been almost similar. And I think the recovery also, there could be some time gap, but recovery may not be much different between small and mid caps compared to large caps. Here to discuss about our Sundaram Emerging Leaders Fund, which is a mid cap and small cap oriented PMS strategy. Last 1 year has been good for the fund. Despite the recent fall, the fund has done well. We have an alpha of around 15%. The reason for having an healthy alpha in the strategy is our disciplined approach towards stock selection. If you observe, we have been very careful on the quality of companies that we pick. We pay a lot of attention on the earnings growth, and not just earnings growth, also a lot of attention on the cash flow generation in the business, underlying business, and then the corporate governance in standards in the companies that we pick. Because as you go down in the mid cap and small cap segments, corporate governance is a key aspect which has to be looked into. Companies with poor corporate governance operating in the similar sector have had differentiated valuations in the same space, and investors have to be conscious about it. And this approach of stock picking has helped us to create this alpha, and in the long term this always pays. In terms of sectoral allocation, our exposures to small specialty chemical and pharma has helped us to avoid the steep fall in the last month. But our exposure to consumer discretionary hurt us. Also, in terms of our underweight position in financials, where we have been very skeptical on the low-rated NBFCs, housing finance companies, and then microfinance institutions, that helped us. Our only exposures in the financial space have been small finance banks, which have done well in the last 1 year. In the last 1 month, things have been difficult, but we are hopeful that things will recover in the next 1 year or so. Consumer discretionary is an area where we were overweight, and that hurt us because in the coronavirus impact, retail companies, consumer discretionary names got hit severely. In our opinion, I think today we are seeing a forced non-spending in the consumer discretionary space, and given the valuation at which some of these companies are, and in the next 6 months we will have a lot more clarity on social distancing relaxation that will happen, and people will go back to high streets, spend money in apparels. They will step out to go to theaters to watch movies, and all this consumer behavior will come back. In the short term, there could be volatility and there could be lower spending, but in the medium to longer term, we think people will come back, and social distancing will start reducing, and situations will normalize. So at the current valuations, these stocks are factoring in almost nil operation for Q1 and a very small recovery in Q2. Therefore, if you keep an eye on the FY22 numbers, some of them are available at really low valuations. So we continue to back these companies like Trent, PVR, Dixon, Orient Electric. They've done well in FY20. If you look at the earnings growth of all these companies, have been really healthy, and we feel FY22 will also be a similar a similar year where growth will recover and the stocks will recover in terms of valuation. In our opinion, these are best times to invest into these companies because with so much of fear, the valuations in these companies are really attractive. So sectorally, we are there in consumer discretionary, specialty chemicals, pharma, and then we have smaller exposures in financials and then materials. So we use this opportunity and we build our positions in Sri Cement sort of companies which are long-term compounders. We got opportunity to invest in them at really good valuations. We currently have some cash in this portfolio. We will look into positive data as they come in and then redeploy it into the stocks. In terms of arguments on whether it's time to invest in large caps or mid caps, our opinion has always been that if you are investing into right mid cap and small cap companies with a consciousness on looking at quality curve, then I think mid and small caps do offer opportunity to generate higher returns for investors from a longer term perspective. And we reiterate again, and with the current valuations and the fall that we have seen in some of the good quality mid cap names in the last 1 month or so, I think our view doesn't change. I think mid cap and small caps do continue to offer good opportunity for investors to make higher returns from a longer term perspective. In the last 10 years, the mid and small cap space have managed to create more multi-baggers, including even the recent fall compared to large caps, and I think that's how the future will also be. But just that the number of options will be very limited. Therefore, a diversified approach towards investment in mid and small cap may not help. A concentrated bet on high quality names is the right way to invest in our opinion. Thanks.